Hi class, welcome back. I'm Matt Fisher, your accounting professor. In today's video, this is going to be a two-part series. We're going to look at investments. And we're going to divide it between debt investments and equity investments and how we account for these types of investments. In this video, particularly, we're going to look at the debt investments. So in a debt investment, that's like bonds, right? Equity is like stocks. Debt investments are like bonds. That's usually the best example that we have. And there are three ways that we can account for these debt investments. They can be trading, they can be held to maturity, or they can be available for sale. And we're going to look at each one of these ways that we can account for these debt investments. So for trading, the business actively buys and sells debt securities such as bonds for a profit, all right? So that's what they're doing. They're actively buying and selling debt securities. So those would be trading if that's what the business is doing. Now, an unrealized gain or loss that changes in the portfolio during the year, these fair value changes that take place are going to be recorded on the income statement. Now, I said unrealized gains and losses. So let's take a look at an example here. Let's say that at the beginning of the time period, our balance in this portfolio was $10,000. And at the end of the period, our balance in our portfolio was $12,000. So we're looking at all our investments, all our debt investments together, not just one. We're looking at the whole portfolio. So it started at $10,000, and at the end of the year, that portfolio was up to $12,000. Well, that's an increase of $2,000, but we didn't sell these investments. I mean, that was just the change in the portfolio. We might have had some sales taking place, but in total, from the beginning to the ending of the year, that portfolio changed $2,000. Well, normally in accounting, we don't do anything with that. But with investments, it's different. We're going to take a look at that and say, well, our portfolio changed in values, and we're going to increase the value of that portfolio by that change, that $2,000. So we would debit an account called fair value adjustment dash trading. We're going to be specific, and we're going to say what type of investment this is. This is a trading type investment. So we'll debit the fair value adjustment account, $2,000, remember, dash trading, and then we will credit an unrealized gain, and we'll put dash income, because it's going to be on the income statement. We're going to actually put this on our income statement, this $2,000 gain. It's unrealized because we didn't actually sell, it's just an increase in the portfolio value, but still we're going to recognize it as an unrealized gain on our income statement. Okay, let me point something else out here. This fair value adjustment account, this debit of $2,000 is an asset account. So it's going to go with the portfolio. So the portfolio will have a balance of $10,000, but then it will also have this fair value adjustment account that goes with it. Okay, and in this case, the portfolio was $10,000, this fair value adjustment's $2,000, so the overall balance then is the $12,000, which is the value of the portfolio right now. Okay, now what happens next year? Okay, next year what happens, let's say the portfolio decreased $1,000. Okay, so it went from 12,000 down to 11,000. Okay, what we want to do is we just want to take a look at that fair value adjustment account, okay, that fair value adjustment trading account. And we're going to say, okay, that has a $2,000 debit balance in it right now from last year, but this year the change is only $1,000. So what happens is we want to reverse out $1,000. So that's what our journal entry will be. It will be reversing out $1,000 of that. And you can see the journal entry there on your screen for the second year when the portfolio actually decreased $1,000, okay? So that decrease is to show how the overall balance in the fair value adjustment account now is only $1,000. So when we're selling one of these investments, one of these trading investments, what we're gonna do is we're gonna look at just the sales price and the original cost and subtract out any fees, all right? We're not gonna take into account the fair value adjustment account. Okay, we're gonna ignore that, and when we have a sale of a trading security, all we're gonna do is look at the original cost, the sales price, and subtract out any fees to calculate our possible gain or loss on the sale of this trading security. All right, so that's the trading security. A little bit tricky, but it makes sense. Now let's move into the next one. The next one is held to maturity. So in this case, if we have a held to maturity debt investment, this means that we're planning to hold it till maturity, and we have the capability to hold it to maturity, okay? So then we're gonna record this at cost, and we will recognize any interest revenue as we earn it. We're not gonna have any fair value adjustment account, okay? All we're gonna do is we're gonna record it at the cost and recognize revenue as we earn it. The next one is the available for sale. Now this one, the definition is that available for sale debt investments basically are those investments that aren't held to maturity and aren't trading. So if they don't fall in the other two categories, trading or held to maturity, then they're available for sale. So they're neither trading nor held to maturity. Their unrealized gains or losses on the fair value of the portfolio is calculated in the same way as the trading, okay? So it's very similar. The only difference is that fair value adjustment, that unrealized gain or loss does not go to the income statement when we're looking at an available for sale. It goes to equity, okay? It goes in the equity section, all right? We'll still have a fair value adjustment dash available for sale account, but that unrealized gain or loss, instead of going to the income statement, it will go to the equity statement for available for sale. So that's the difference between the trading and the available for sale when we're adjusting for fair value. All right, so let's take a look at an example. Let's say that our portfolio was $15,000 this year, at the beginning of the year. At the end of the year, the portfolio had a $16,000 balance. So the available for sale portfolio increased $1,000. So we're going to debit the fair value adjustment dash available for sale. You've got to be very clear there. You have to say available for sale because it's not trading. It could be, if you just said a fair value adjustment and you didn't specify, then the reader wouldn't know if it was a trading or available for sale. So we would, in this example, say fair value adjustment dash available for sale, and we would debit it $1,000. Then our credit would be to the unrealized gain, because it's a gain in this case, and we would say dash equity, because available for sale goes to equity, okay? And that would be for $1,000. So that would be your journal entry to adjust for this account, all right? The sale takes place just like in the trading, okay? We don't take into consideration the fair value adjustment account. If we have a sale of one of these debt investments in our portfolio, we will look at the sale, we'll look at the original cost and take into consideration the sales price and any fees that took place, and that's how we would calculate any gain or loss. We would not use the fair value adjustment account in calculating any gain or loss. All right, class. That's quite a bit of information for you, right? You might want to go through this video 1 or 2 more times. Make sure you look at your textbook. Textbooks usually have some good information. Remember, we do have notes that go along with these videos, so you can take a look at those notes. And I wish you the best of luck in this. Make sure you go over it and really spend some time making sure you understand the difference between these 3 accounts. In the next video, we're going to go over investments, but equity investments. So we're going to be looking at basically stocks. All right? See you soon, class.